Recently, we've been going through a rough patch. A severe economic turmoil, inflation was at 40-year high levels, Fed's interest rates were the highest in 15 years, and mortgage rates have risen from 3% to over 7% last year, reaching a peak value in over 20 years. Despite recent drops in rates, we can't help but wonder, is everything just calm before the storm? Can mortgage rates grow even further? First, I must say that everything you hear in this video is not financial advice. We are neither an investment advisory service nor an investment advisor. Data and information provided are solely for educational purposes. Mortgage rates, despite being a hot topic right now, are not that easy to predict, especially given the uncertainties and problems we've experienced last year. High inflation and Fed's attempts to control it, war in Ukraine, energy crisis, etc. Those problems did not go away and continue to affect the US economy. Experts and analysts don't have a universal prediction on what will happen to mortgage rates in 2023. Some analysts predict a sharp decline in rates all the way down to 5% for the 30-year fixed mortgages as opposed to the current 6.27%. Others expect rates to rise substantially, reaching 9.31%. For 15-year fixed mortgages, predictions vary from 4.5% to 8.75%. So according to these predictions, the average rate for a 30-year mortgage will be around 7% and for the 15-year around 6.42%. However, rate movements are too unpredictable and the rates could easily rise while you're waiting for them to fall and vice versa. According to other sources, fixed 30-year mortgage rates will average 7.4% in 2023 with a slow retreat to 7.1%. This means that a typical monthly payment will reach $2,430 for a home purchased in 2023, which is double of what people paid in 2021. The Redfin agency has calculated that you need to earn over $100,000 a year to afford such payments. Huge numbers without a doubt. However, don't let your mind run amok. The fact that someone is predicting the apocalypse doesn't mean that it will really happen. There are many analysts and economists who are rather optimistic and predict a decline in mortgage rates. For example, the Mortgage Bankers Association predicts an average of 5.4% at the end of 2023, saying, "We expect significant volatility in rates in the near term due to quantitative tightening by the Fed and other central banks, and as markets grapple with significant geopolitical, economic, and monetary policy uncertainties." Keith Gumbinger, a vice president of HSH.com, predicts similar numbers, saying, "We should see less volatility for the 30-year fixed mortgage rates in 2023, which are likely to hold a range between 5.875% and 6.875%. But higher short-term rates will likely see the run in a 5.125% to 6.25% range next year. Mortgage rates are very volatile and we cannot accurately predict what will happen next year. However, we can at least understand what caused the rates to spike. There are multiple factors that have affected the mortgage rates, such as inflation, interest hikes, stock market volatility, fears of recession, supply disruptions, etc. Let's look at each one and see how it contributed to a two-time increase in mortgage rates in a single year. First, inflation. When the general price level of goods and services in an economy is rising, it can lead to higher interest rates. This is because lenders will typically want to earn a higher return on their loans to compensate for the fact that the money they lend will worth less in the future due to inflation. As a result, borrowers may have to pay higher mortgage rates to compensate for this added risk. Second, Fed actions. Since banks that give out loans are borrowing money themselves, the rates of their borrowings are closely tied to the interest rates set up by Fed. If we look at the graph of Fed increased interest rates and overlay a graph of mortgage rates on top of it, we'll see how much mortgage rate spikes are a direct response to increases in interest rates. Third, market volatility. The majority of banks and lenders don't actually hold on to the mortgages they give. They package mortgages into bonds and sell it to investors, guaranteeing returns with interest. When those bonds are sold, money the banks earn allows them to issue more mortgages. So if investors are skeptical and cautious, they don't buy new bonds. Thus banks have less revenue and have to raise mortgage rates. That's exactly what we see right now. Fourth, fearing the recession. As more and more people tend to save money instead of spending, the number of purchases decreases. Money preservation actions among US citizens prevent people from getting new loans and paying bank interest, which in turn doesn't allow banks to earn enough money to pay off their own loans. Thus, banks are basically forced to increase mortgage rates in attempts to squeeze every penny they can. Fifth, supply chain disruptions and labor problems. The housing market is the main area of mortgage enthusiasm. If people have houses to choose from, they take mortgages and buy them. Currently, there are sudden disruptions in supplying building materials and finding skilled laborers to build houses. This drives up prices for new homes, which in current situation doesn't mean increased demand. Houses cost more because there are not enough materials and builders, and potential buyers prefer to save up their money, so less mortgages are getting signed. So banks once again don't earn enough, which forces them to bump up mortgage rates. It is all connected, as you see. Rising mortgage rates are not good for anybody. When mortgage rates rise, the monthly payments on a home loan also increase. This can be a burden for homeowners who are already stretched thin with their budget and may even make it difficult for them to afford their monthly mortgage payments. Additionally, when mortgage rates rise, it can lead to a decrease in demand for housing. This is because potential home buyers may be hesitant to take on a mortgage with a high interest rate, leading to a slowdown in the housing market. The housing market plays a significant role in the overall health of the economy. If rising mortgage rates lead to a slowdown in the housing market, it could have a negative impact on the economy as a whole. So we need to understand what to do to prepare ourselves for rising mortgage rates. Here are 6 actions you can take to avoid losing money if you are shopping during spikes in mortgage rates. 1. Lock in at a low rate. If you are in the process of shopping for a mortgage and are worried about rates rising, you may want to consider locking in a low rate. This involves paying a fee to the lender to secure a specific interest rate for a set period of time. This can protect you from rising rates and ensure that you don't end up paying more for your mortgage than you had planned. 2. Make a larger down payment. A larger down payment can help you secure a lower interest rate on your mortgage, the amount you need to borrow, which can help you qualify for a lower interest rate. 3. Consider refinancing. If you already have a mortgage and are concerned about your rising rates, you may want to consider refinancing. This can allow you to lock in a lower interest rate and potentially lower your monthly payments. However, it's important to consider the costs of refinancing and whether it makes financial sense for you. 4. Adjust your budget. If you are unable to secure a low rate or refinance your mortgage, you may need to adjust your budget to accommodate higher monthly payments. This may involve cutting expenses or finding ways to increase your income. 5. Consider a fixed-rate mortgage. If you are worried about rising rates, you may want to consider a fixed-rate mortgage. With a fixed-rate mortgage, the interest rate remains the same throughout the life of the loan. This can provide stability and predictability in your monthly mortgage payments. 6. Consider refinancing. Of course, these 5 suggestions are valid only in situations when you need to take a loan and buy a property. However, if you have choice and time to wait, it can be much better to wait for rates to stabilize. Since mortgage rates are closely tied to inflation, when it will eventually go down, so will the mortgage rates. Plus, the housing market is expected to stabilize, giving people more options to choose from, which should put an end to bidding wars and consequently lower their asking prices. Everything we say in this video isn't financial advice, so if you are planning on getting a mortgage or doing anything to the one you have now, we strongly advise you to seek help from professionals. Of course, changes in mortgage rates are a serious cause for concern to you, but I must say that you, first of all, should manage your money responsibly. Your financial success depends not on Fed's actions or increases in interest rates, but on how you administer your personal funds. Mortgage rates can go up or down in 2023, and these fluctuations will definitely worry many people. But always remember that before making any big decisions, it's necessary to ask for professional counseling. Here are 5 actions you can take to avoid losing money if you are shopping during spikes in mortgage rates.